Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for September 12th, 2022. We are recording this at 1 p.m. Eastern Time, and this is episode number 358. My name is David Kosmeter. I'm the creator of TimingResearch.com, and you should be seeing my screen right now. And today I have arranged for Norman Hallett of the Disciplined Trader to be back with us, and Dennis of CastAwayTrader.com, who's first time guest on CFN, and the option professor of optionprofessor.com is back to moderate. So I'm going to go ahead and turn it over to him.
Okay, thanks a lot, David, and welcome everybody. We got a very big show here today, and of course, a very exciting market that we're running into. A lot of volatility in the last couple of months, so we're going to talk to these guys and find out where we're going to be going possibly. Before we get started, let's introduce everybody. First one up is Norman Hallett from the Disciplined Trader. Norm, a little background on what you're doing down there and what you're thinking.
Well, we're very busy here because the markets are very kind of confusing, and that causes head problems. And that's our primary focus, is helping traders with their mental and emotional capabilities. In fact, we've been doing a little study lately and on the idea of prop trading that seems to be taking hold, where people are unsure about betting their own money. It seems much more comfortable to bet somebody else's. So I've been kind of angling toward helping traders understand the need for the mental and emotional part of trading more than ever when you do something like prop trading with tight rules. So that's our focus always. But, you know, I'm a trader, and the bottom line is just, show me a chart and get me excited. That's where I'm at. So I appreciate being here again.
Sure, you bet, Norm. And we'll get into a lot more stuff with you in a little bit. Dennis of CastAwayTrader.com. Dennis, a little bit background on yourself and what's going on down at Castaway?
Yes, thank you for inviting me. So I am a host of CastAwayTrader.com, and my primary trading tool is the Harmonic Elliott Wave Theory, which is a modified, in my opinion, better version of the Elliott Wave Theory. I started my trading career in 1997. I worked on a trading desk of a bank for 3 years, and we traded like monkeys. We didn't have any tools, so I left the industry, made a successful career, grew into CFO position, CEO position. We sold the company we managed. Everybody got, healthy cut, and I got early retired in my early 40s. And I decided, to rejoin the industry, and I started to look for reliable way of predicting the market. And I practiced the classic version of the Elliott Wave Theory for several years until I realized that it had so many flaws. I started to search for better version, for a holy grail. And finally, I came across the Harmonic Elliott Wave Theory. And since then, I've been using it as my primary trading tool and forecasting tool. And today, I think I will have a chance to share my charts and discuss with you what I can envision here.
Great. And maybe because I've been familiar with some of the different interpretations of the Elliott, maybe we could look at some of the different sectors like commodities, interest rates, and the stock market, and get an idea of what you're seeing on the Elliott Wave. That might be helpful for a broad lens on some people. You know what I mean?
Yeah, today, frankly, I prepared a S&P 500 chart,
sure.
And I would be talking about S&P 500.
Okay, we'll stick with that. Are you familiar with what the interest rates look like, or the commodities, or you're not really focused on that?
Yes, I also focus on crude oil, natural gas, precious metals, and I also keep watching interest rates as well.
Sounds great. All right. Well, maybe we can just get a passing comment on that later in the broadcast. In the beginning here, we always, on Monday, we throw everybody in the hot seat by going over where your opinion is for the rest of the week. So we use our starting point at the opening of the S&P, using the cash S&P open of 4083. Where do you guys think we are going to end the week, Friday? And what is your confidence level? We'll stay in the same order. Norm, what are you seeing from 4083? You got a head start if you think it's going up, but what do you think?
Well, first of all, Dennis, welcome back to the trading world. I'm going to be interested to hear your opinions, especially on a couple of markets I'll be commenting on, because you look at it a whole different way than I do. So that's great.
Exactly.
As far as the S&P is concerned, or the markets in general, I'm looking for a lower market. I think if you pull back that chart, give us a little bit more time on it as it was before you zoomed in.
Right.
I think you can see a pretty clear downtrend if you connect those top lines. We may challenge that 4,200 area, but that could be done today for all intents and purposes. It can go quickly. So from as long as that yellow average stays below or pops above and then hesitates and comes back below, I'm a seller, and I at the right times. I trade shorter term charts, but it looks to me as if we may have a day or two rally, but by the end of the week, I think we'll be at lower levels than we are right now.
Do you think it could look a little like the May-June rollover there?
Yes. I'm looking at the May-June rollover. I'm looking at the same kind of rollover back in the very beginning of the year in January. Where you have 4 or 5 up days in a row, and I don't count that. I think you can see some real consistency on those moving averages. They got the 34 and the 10. I use the 8 on the other, but it shows me pretty much the same thing. But you can see how it seems to be honoring that line. The only thing that could get in my way, and it's a big thing, and that's that. A lot of people are going to identify this head and shoulders bottom that we're seeing here. And that if we do cross that moving average, that could be a certain degree of confirmation, but we still haven't gotten over the other shoulder,
right?
That was formed in the beginning of June. So, this market I think has been famous for conflicting indicators.
Yeah.
I think that, I think the key here is to trade small and pick your spots. So, I'm looking for lower markets by the end of the week.
Yeah. And your confidence level about percentage wise?
My confidence level is about the 66.667 area.
For more likely than not. Yeah.
Yes, exactly. I do think so. Yes.
Yeah. Okay. Dennis, what are you seeing between now and the end of the week regarding the S&P? Again, using a starting point of 4083, lower or higher than that point by the end of the week?
So I'm considering that move up of the low made at the beginning of September as a corrective ABC up pullback. And looking at micro charts of ES mini and NQ mini, I see that structure completed with today push higher, and both ES mini and NQ mini that are highly correlated with S&P 500 cash index you are talking about, they hit my targets for that bounce, and they retraced 50% of the preceding decline we got of the top we got in mid-August. So that could be the first move down in the microwave 1, followed by pullback in the microwave 2, that is about to make a lower high. And that's actually a classic bearish setup for a strong decline in wave 3. The only complication we have to speak about focused is that we have that massive OPEX event at the end of this week. We have the highest on record expiration for options, and I've been watching like a clear pattern again and again. When we deal with an OPEX week. We normally start on a bullish note on Monday, and then normally on Tuesday, Wednesday, we have bearish days. But on Wednesday and Thursday, big guys, option dealers who sold massive amount of puts, they do a great job to keep that market afloat. And that bullish seasonality actually expires on Friday morning when SPX and NDX option expire. So after like 9 a.m. on Friday morning, they are not longer interested in keeping that market afloat. And this is why quite often on OPEX weeks, we start getting some bearish move only on Friday.
Mm-hmm.
So it's, I think that we are about to top this week in a corrective bounce.
Mm-hmm.
But I think that we would not probably get really big move down that Friday. Probably we would get it either next week or after FOMC date on September 21st.
Right. So basically, you're thinking that it could hang in there because of options expiration until
Yes.
Friday. But
Yes.
do you think if it's going to deteriorate to the downside, it would happen more towards the end of the week?
I think it will start deteriorating next week or the week after FOMC on September 21st.
So you're kind of constructive about the market between now and Friday from where we started at 40.83. You're kind of...
No, I think that basically when we get a corrective bounce and the market turns down, we should never expect acceleration right away. So the way how market starts a new impulsive move down is a sequence of smaller moves up, and every new move up, it gets stronger. So this is why I keep telling my subscribers, it does not make much sense to try catch the very top, because even if you catch the very top, the first couple of squiggles down would be small.
Right.
And we have, for example, for ES Mini, the main support now at 4,080, and on December contract. And the first goal for bears is to break under 4,080.
Right.
But even if we break under 480, we would immediately get a corrective pullback because bulls would pretend like nothing happened.
Right.
And only after that bounce, we can expect an acceleration on the way down.
Right. I got you. So, you could get a little bit of a drop and then a little bounce back up. But over time, by the end of the month, more than likely, it's going to start going back down.
Yes, this is my primary bearish scenario. And
I got you.
Later on, I will show you an alternative scenario, which is less probable, but it's still probable.
Sure. Okay. All right. Well, again, Norm, anything behind the curtain that you want to talk about, fundamentals or technicals that you're kind of looking at to kind of reach your conclusion that we might roll over by the end of the week? Norman.
Okay, I'm back. Sorry.
Yeah, just wanted to know if you had any fundamental or technical things you are looking at that's going to make your opinion come to pass. I pretty much have described what I look at, and that's that's in the short term. I'm always interested when I hear somebody who is in the harmonics or the Elliott kind of area of analysis. I love that because it gives me a general look at it, but then I have to decide what to do with that. I call it an undertow. When you look at these more general views, waves and even cyclicals and seasonals and waves, these are I look at them as an undertow in the market that you need to respect, so that in markets like this, and I've been doing this a lot on a short-term basis, I will only take short trades. Okay.
So when I see when I see a chart that looks like this, right, and I hear I hear somebody as educated as Dennis is with harmonics talking about the final the final straw will be some down move with some strength.
Right.
I trade from the short side, and when I say I trade from the short side, I will take a long signal. But it'll be, I use my position sizing in that. In other words, my larger positions will be on the short side, right, and any counter position. So that would be the only thing I mention, other than what I'm seeing here, and that's a lot of question marks in the market the last 2 months. But the wild swings can make you. All I know is the guys that I play tennis with are still concerned and asking me what stock is hot, then I can't give him a very good answer. But
Yeah.
that's the way I look at it in general.
Yeah, I heard Leon Cooperman, one of your neighbors down there in Florida, says that he's selling into strength, and so basically it kind of jives with your idea that you're looking for places to sell, not necessarily places to get a really long, especially on rallies.
Yeah, I think that's always served me. I look at trading as a accumulation of edges.
Mm-hmm.
And the more edges that you can give yourself, the better. It's we're going to take a look. You want to ask me a further question about the market that I'm looking at. We're going to take a look at silver.
Mm-hmm.
I want to show you kind of what I mean in that respect. But yeah, I'm favoring the short side with my trading. That's the way I'm handling the S&P market and all the indexes.
Do you want to share your screen, Norm, and throw the silver up there while it's on the tip of your tongue here?
I'm not in the computer where I have the
screen sharing
chart with me. Yeah.
Okay. All right.
But when you do,
maybe,
at some point.
maybe David can get up there later. Dennis, again, you gave us a little bit of an idea of the waves that you're kind of looking for.
Yeah, let me share my screen.
Okay, you should be able to do that now.
Yeah, it's good when we share screens with the speaker so you can kind of illustrate what you're speaking.
Incidentally, I just found a way, so I'll be good with the silver later.
Okay, good.
Okay, do you see that? Do you see
Yep.
my chart?
I think we do. We all the
Okay.
ABCs right there. Yeah.
Cool. Yeah. So basically, this is my primary bearish scenario. And you can see that I believe that in March, April 2020, that strong drop was completion of a corrective wave 4, and of the bottom made by corrective wave 4, we got a completed structure of wave 5. And this is how the 5-wave up fractal looks like under the Harmonic Elliott Wave Theory. You may know that the main idea behind the Elliott Wave Theory was that every trending move up, a sequence of higher highs and higher lows, is structured as 5 waves. They call wave 1, 3, and 5 impulsive waves, and those waves make higher highs, but they are interrupted by 2 corrective waves, waves 2 and 4. The problem, another cornerstone of that theory was that inside wave 1 and wave 3 and wave 5, there are small 5 microwaves. So that sounded great in theory, but once you start applying it in trading, you will start seeing a lot of imperfection, incompleted structures. And those guys from the classic Elliott Wave Theory, they came up with fancy terms like truncation, meaning like here the theory doesn't work, but let's assume we got a perfect completion. It's great if you're an analyst, and it really sucks if you're a trader, because if you try to nail the top and you don't get that final 5 microwaves up, so basically you are left behind, market turns down, and you do not longer have confidence, you do not longer have a setup to trade. So this is why probably around 20 years ago, a guy named Ian Copsey came up with that creative way of modifying the Elliott Wave Theory, and he called it the Harmonic Elliott Wave Theory. And the main modification he made was that he said not only corrective waves 2 and 4 were subdivided into 3 waves like ABC, but also waves 1, 3, and 5 are also subdivided into ABC. By doing that, he kind of relaxed, rules for the market. He did not try to impose the rigid 5-wave up structure for every single move up or move down inside an impulsive wave. And this is probably the main reason why that theory, in my opinion, works better in real life. So coming back to that 5-wave up fractal, we started that fractal at the lows made in 2009, and we could perfectly count 5 waves out of that low right into the top made in January 2022. And what normally should follow once we complete 5-wave up fractal, we should expect a large ABC down structure, and Elliott wave traders and analysts call it 3-3-5 because it got 3 microwaves down, it's A, 3 microwaves up, it's another 3, and 5 down. So the primary bearish scenario considers the move down into June-July as the first leg down in wave A, large wave A, and a bounce into mid-August as a large wave B, which is supposed to be followed by a 5-wave down decline. And that 5-wave down decline should start from a micro setup 1 down, 2 up. This is what I told you, that big moves down, impulsive move down. These start from small squiggles that are followed by deep pullbacks, and every new move down, every successive move down, it gets stronger and stronger until we go into subwave C or wave 3. This is kind of the strongest acceleration where it happens. And wave 5, it produces positive divergence. So coming back to the chart, so my primary bearish scenario says that that first 3 move down found support in May, and then we got ABC up in expanded flat structure. And that expanded flat structure meant that even a corrective subwave B managed to make a new lower low. That actually tells us how strong the bearish, underlying bearish momentum was. And that pullback in that topped in mid-August, it actually completed a corrective A up, B down, C up bounce. And off the top, under that fractal, corrective fractal, I expect to get 5 waves down. Now I would like to discuss briefly what actually perma bulls expect here, because we always should understand what's on the mind of another camp. So they think that ABC move down was just an ordinary pullback, and after that wave 4, we need to expect another 5-wave move up that would make a new higher high. And the problem with that count is that the drop that found support in June actually dropped under the critical support produced by subwave B or wave 3. So under the Harmonic Elliott Wave Theory, wave 4 cannot go under the low made by the previous pullback. The whole idea of the 5-wave up fractal is that it describes a trending move. And any trending move is just a sequence of higher highs and higher lows. Once we make a lower low, we can no longer expect another push high in wave 5 up because it could no longer be considered a wave 4. And this is what happened here. We have to consider wave 4 Z low made in October 2021 because it made a higher high in comparison to the preceding low made by the previous pullback. But when we get such a big move down, it could no longer be considered a wave 4. This is why I consider the move up of the March 2020 as a completed wave 5. And that wave 5 is supposed to be followed by a large ABC down. Now I want to show you an alternative count, which is actually a feasible alternative. So it's possible that we got 3 down here into June low, and that push into mid-August was only part of that 3 up structure. This is the same fractal, so the bearish under the bearish count, we are here. So the mid-August was here, but under that alternative feasible bullish scenario, we are starting that second leg up, which would make anyway a lower high in comparison to the high made in January 2022. It would be a lower high, and that count would not allow bulls to make higher highs over the highs made in January 2022. But anyway, we could get like a considerable rally to that red target box. So under that count, we could get that move up. It's micro 1, then would be 2 down, 3, 4, and 5. And that move would find resistance somewhere either at 76.4% retracement of that big decline or 66.7% retracement of the decline. Now, how we could differentiate between those two scenarios. So on the one hand, we have that alternative bullish scenario where we are starting a 5-wave up move. On the other hand, the primary count considers that move up as a corrective wave 2. So first of all, I would look at that EMA 21 on a weekly chart. So when we dealt with a bullish trend, you could see that that blue line used to work as support. So basically, it caught every single pullback in 2020 and 2021 until in February 2022. It turned into resistance. It changed the slope. Now it started to look down, and it actually produced resistance in February 2022. Then bulls managed to overshot it in April, but then it dropped back under. Here we overshot it again in July, and now we are exactly at that level. So that EMA 21 is located around 4,100. So if we have a weekly close over that line, so most likely we would get bullish follow through. But even more important resistance for me would be 66.7% retracement of the decline of after the pullback made into mid-August. So if we go over that level, 4,172, probability of that bearish count would drop significantly. And that would be the signal that probably we are dealing with that bullish alternative scenario. But even under the bullish alternative scenario, we can only expect a 5-wave move up into a lower high, somewhere around 4,400 or even 4,570. And it should start with 1 up, 2 down structure. So it does not make sense to try to chase that market. So even if we deal with that alternative bullish scenario, I would be expecting first a pullback here of that level we are now, or maybe a little bit higher. And if we get an ABC down structure, which is basically the bread and butter of any Elliott Wave trader, that would be an alternative, a potential long entry. So we need to get a micro ABC making a high low. And in that particular case, we could go long, setting a protective stop under the low we got at that point when we bottomed on September 9th.
Okay, I got a couple of things I just wanted to summate here for you. First of all, you're looking basically at this 4178 as an important number, and you're using 66.70. I was using 61.8, and I was getting 4155. You know, you don't squibble over 20 S&P points.
The problem is, I call it 61.8% retracement and 100% extension like cheesy levels,
right?
Because everybody knows them, and this is why they do not work.
So and then they peak through for 20 S&P points, and maybe they turn it down after that, right?
Yeah, this is how algos probably are coded. This is why we keep playing with those two numbers, and this is why, for example, 138.2% extension is much stronger than 100% extension. And
then that's also part of that harmonic Elliott wave versus the standard.
Yes.
Gotcha. That's a good thing. So anyway, underneath 4080, that might, be somewhat of a turning point, and getting above 4178 would be some kind of a turning point. So it might be interesting to let the market decide which theory is going to work better, right?
Yeah, so basically we should not, get married to any scenario.
Right.
So I always show two most probable scenarios, and then we just expect a favorable entry, which is a pullback after a strong move up. So after that move up, we get a corrective looking pullback to, let's say, 50% retracement that looks like an overlapping ABC. That would be a potential long entry, and we would start considering that alternative long setup seriously.
Okay. The other thing is obviously the Fed is on your side if you're looking for the thing to wind down, because it seems like they're interested in higher unemployment. They're interested in lower earnings. They're interested in a slower economy. And obviously that could be negative for stocks. So, at least when you're talking about this unwinding of these rallies, you do have the Federal Reserve policy behind you, which is not a bad thing to have behind you, right?
Yeah, by the way, on that chart, you can see the green line, which is 50 weekly moving average. So normally people focus on daily moving averages, but I like to use them on any other time frame, including weekly, including 50-minute. And on that weekly chart, you can see that we are still on the 50-day moving average. And not only that, the 50-day moving average has a negative slope. So it's completely different game if to compare it with what we have in 2000 and 2021, when those all major moving averages used to have a positive slope.
Right. Now, since we have your stuff up there, and then we're going to turn over to Norm, and he's going to show the stuff that he's working on. Can we just go over the crude oil and the gold?
Well, can I ask before you?
Sure, Norm. Yeah.
Before you,
leave this. Yeah.
I understood about 1/3 of what you said, Dennis, but that and I'm part of me is proud of that, because somehow I've been getting fairly good results with my trading over the years with less lines on the chart and less. But when I listen to things like harmonics, it does help me to phase one way or the other with my position sizing. I'm looking here. If you join the tops of the top C with the 5 on it, and then the B and the A, you make a line down there. It crosses. If you give it a couple of days, it crosses right at that 41.78 area. In other words, that seems to be a place where that line is going to hit, and that would be the line that I would be looking at to make a move one way or the other. So I just wanted to mention for those that are looking at this and saying it's a lot of lines, and it's I leave the total understanding to Dennis, and then I do what he says from that standpoint. But it's interesting to see how some more traditional to some more elementary trend lines or something, can come to the same conclusions, which makes me feel good, that if we all come to the same point. I think you came to the same point in a different way. So the three of us have kind of looked at the same point in 3 different ways, just kind of throwing that out to traders, that, whether you understand it's good to take the advice of somebody, and then, if it matches what you're doing, you can feel a little bit better about it,
Yeah, I would just note, that people tend to overcomplicate the Elliott Wave Theory. And in fact, it's simple. The whole Elliott Wave Theory is about 2 repeating patterns. When we deal with a rally, we deal with 5 waves up. Everybody can count from 1 to 5. And all those labels, you can use anything else. You could put like cat, dog, mom, dad. It's just the way how we label them to, to keep them organized and to be able to match them to that model. And the second repeating pattern, it's ABC. Again, everyone can count ABC, A, B, and C. And, again, we have so many different labels, but you can delete them from the chart, and you can just, it helps you to visualize how normally price plays out a corrective pullback. And you will be amazed that again and again, we see the very same pattern to play out on any time frame, on futures, on stocks, even on options. And once you get that ABC pullback after a strong move up, it's an attractive long setup.
Yeah. So again, Norm, in concert, basically what you're saying, this gives you a broad roadmap, and then you go to your charts and your moving averages and your daily, weekly, monthlies, hourlies, whatever you're doing, and you get some kind of a technical confirmation of what the broader picture might be saying. I think that's kind of what you're saying. They can be used. They can be used in concert.
Exactly, and there was a screen up there that talked about an alternative. This is when I've watched Harmonic and Elliott Wave analysts talk. There's always an alternative. The alternative scenario, and that's really where I get mean, you're not, it's one thing to predict, but it's one thing to know that these cycles can change, and that we don't know everything about the undertow.
Right.
So that, I at least I have two scenarios to work with at a critical point. And, that's kind of what I take from it. And of course, I take the fact that you're into the 8-bar exponential moving average, which I like. So that's good.
Yeah.
Yeah,
Well,
in my opinion, we should always consider at least two scenarios, because even if we have confidence in one scenario, if something goes wrong, if you never thought about your plan B, you kind of get lost, like, a deer in the headlights.
Right.
And this is the main enemy of any trader, which is uncertainty. If you're unprepared for a plan B, you basically, you get stalled, you don't know what to do, you get paralyzed.
Right.
And even if you do not like, so I do not like that scenario, I do not play for that scenario, that alternative bullish scenario. But if it starts happening, I would not be lost. So I would immediately switch to that scenario once I see a corrective ABC down making a higher low. That would be like the first bell for me that probably, I need to allocate more probability, higher probability to that scenario. But, if I only look at one scenario, something goes wrong and basically I'm lost.
Yeah. One thing, Dennis, is essentially we're looking at the 43.25 being the rebound top, according to what you're thinking, and a 5-way wave to the downside. Could we go to a longer term chart and you give us an idea of what the next 6 or 12 or what the next 5 waves might have as targets? I think you had it up there just a little while ago. One more back, I guess.
Yeah, so basically,
so get an idea of what this means. Yeah.
Under the Elliott Wave Theory, when we make that wave 4, which is followed by the final ABC push higher, the low made by wave 4 becomes a magnet for the first large corrective structure, and at the same time, it's a support, a very strong support. So very often, once we have a huge or large or even small 5 waves up, we would see a bunch of ABCs that eventually would come back down to retest that low. That essentially means that, in coming months, we would see something around 2,200, the low made in March 2020. And once we go to that level, it could be somewhere here, it could be somewhere here, or a little bit lower, then we would get a large ABC up pullback, which would retrace part of the decline, maybe 50%, maybe 61.8%. This is the main idea. Once we get that ABC move down, then would be the big question. Are we going to get only a corrective ABC bounce, or we are going to start a new 5-wave up rally? And normally, when we deal with A down, B up, C down structure gets not only stronger and covers bigger distance, but it takes more time. For example, I recently reviewed a similar structure from 2008. That wave C down was bigger by 2.2 times, and it took 2 times longer than the first leg down. So it keeps going lower, lower, and lower. It keeps leaking lower. So basically, it took S&P around, let's say, 5 months, 5-6 months from January 2022 until June, July 2022. That means essentially that the second leg down would take 10-12 months. So we are talking about a potential bottom next autumn, maybe August, maybe September, maybe October.
Right. And one other thing is when the 3-leg comes down there, it might be a fast and furious, then have a bounce to 4. And are you saying that when we go into that 5 wave, the RSI may not be lower than it was on the 3 move? And that's your divergence you were kind of talking about, or?
No, normally when we have a divergence, the strongest part of any rally is wave 3. You see, it's in the middle of the move.
Right.
And particularly sub-wave C or wave 3. this is where your RSI and MACD would show the highest readings.
There you go.
And this is where you do not want to actually fight it. But then after a small pullback, after resetting those indicators,
Right.
bulls make another push. But look, that push is much smaller than the
Right.
preceding push. And this is why, this is the main reason why we get those negative divergences, because
Exactly.
that final push in size and time is much smaller than the preceding one in wave 3.
That's
The
great.
same happens on the way down.
All right.
Then we deal with 5-wave down structure.
Right.
When we get a bottom of subwave C or wave 3, the strongest part of the decline, you will get the lowest readings in all your indicators. Then we get a pullback, a bounce, and the final push down, which is structured as ABC. And at that point, all your indicators would be showing higher readings and price would be showing lower readings. This is the reason why we get those negative divergences, because of that specific price structure.
Yeah, if this actually plays out, it's going to be a scenario where the Fed wins and they get everything to slow down. And then after it slows down and we get these big sell-offs, businesses adjust their businesses accordingly. And then basically that's how you start the new bull trend. I mean, that's how I see it.
Yeah, Goldman Sachs today announced that we are cutting hundreds of jobs now in
Right.
September.
Right.
and they keep telling us that it's not recession yet.
Right. Right.
I wanted to, Dennis, can you put your cursor near at the very top, near the C5?
Yeah.
The right, that red candle that is moving lower right under the C is followed by a doji or a very small spinner the next day.
Yep.
The next day. I just want to show you a trigger that I use that doji followed by an extended move through the 8-bar exponential moving average, which is that 8-bar, is my trigger to go short in that case. I'm just showing you the simple way that I would take a look at a chart. What I do is I generally take a scalp on after that the long body that you just pointed to. The long body that went through the 8 at the top to the south side, and you look to take if you look at the current market again at where you have CB about 5 weeks before. This is a weekly, 5 weeks before. You see that same kind of a pattern where you have a small body followed by an extended move through the 8, and you would have had your scalp there also. But that's really where and I kind of look at that. I wanted to show that trigger to everybody because I'm going to show it to you on the other. And if you go way back to the very beginning where the E is at the very beginning in 2020, in March, you'll see that same. There's a doji or a spinner followed by a strong move through the 8, which led to some more downside. So I'm always looking at. I call it the loaded gun trigger. Where it kind of looks like a trigger with the barrel of the gun pointing up or down. But I wanted to make sure that I pointed that out.
Sure.
Yeah, it's interesting that in both cases, actually here and there, price came back up to retest, that EMA, and only when it failed to actually reclaim it, this is when acceleration started. And here, and the same was here. So we left, two those tails, and showing that price actually got rejected and we dropped. And basically we always, when we have that small candle after a big move, so it could be two scenarios. One, it's so-called bullish sandwich, when another big green candle goes up confirming the direction, or it turns into like evening star, right? When we get a red candle going down and leaving here like abandoned baby.
Yeah, and I think in our basic rules, when we trigger ourselves in, again going to the top there by the 5C, when we trigger ourselves into something like that, if the market closes twice over the 8, that's an exit signal. Didn't do it there. You showed some wicks that tried to cross back over the. We have that top arrow. We have the 2 wicks that tried to crossed over the 8, but didn't close, but closed below it, which would have kept you in that market on the way down. So again, it's I just want to kind of scream to people that there are many ways to come to similar conclusions. And so most traders have a pretty good trading plan. They just don't have the trust in it to follow it, because they don't understand it. They don't understand why they're asked to do something. You got to understand the whys of a trading plan also. So I'm really glad that you've taken some time today to give us a little bit of the detail about why you do what you do.
Yeah, in my opinion, there are a handful of different ways to trade. And the main problem what newbie traders have is that they keep looking for fast, easy results. And the problem is there are no good probably and bad methods. There is insufficient time people invest in, polishing those methods. I always tell people, before a student pilot is allowed to fly a plane, he would be required to get several thousand hours of flying experience. And before, a surgeon is allowed to make surgeries, he would be allowed to go through extended practice. So for some reason, people think that they could buy a book for $10, they could read the book, and the next morning they will become a pro in trading. As in any human activity, unfortunately, to build some experience, to turn experience into skills, unfortunately, we need time. And this is the main problem with majority of traders. They keep switching from one method to another one. You can perfectly trade with only moving averages without learning. If you know someone who will be willing to share with you how to do that, and if you have time and stamina, to keep practicing. So practice is everything.
Dennis, there's a 70-year-old individual who's just retired and wants to learn trading. Does he or she have enough time in their life to do that, according to
Absolutely.
how many hours they need?
Absolutely. I think, if you have time and you have money, you don't need to trade big. You can trade for $100, $200. And this is the trick, actually, right? It does not make sense to do paper trading, as we say, because your emotions will not be involved, because the main problem is to overcome your emotions. The main problem, the main way to succeed in trading is that you need to automate your trading. Is the way, again, how pilots perform takeoffs and landing. They did that so many times that it became automated activity in their brain. In the same way how we drive a car from your home to your local supermarket. You do not think about that road because you've done it so many times. And only if some emergency happens along the road, this is when you start paying attention. So if you keep trading one simple pattern, one simple setup, again, and again, and you do not let yourself deviate from that pattern. So soon enough, maybe in 3 months, maybe in 4 months, you will become a pro in that setup. And the main goal is just to stick to one and keep performing that one, so you would turn your experience into professional skills.
Do you hear me clapping? Do you hear me clapping, Dennis? Yeah, I mean, I've always felt that simulated trading is way overrated. I mean, it's a great way to understand how to pick up the mouse and put in a trade. But once you have the mechanics of placing trades and exiting trades, you got to put some skin in the game in order to see what kind of emotions are going, because every time you increase your exposure, it's going to introduce more on the mental and emotional side. So I'm really glad that you've emphasized that.
Hey, Norm, we've got a little bit of time left. Can we go over a couple of things that you're watching, including the silver and maybe the US dollar and interest rates? Because those are three markets that I think are getting pretty interesting.
You should be able to share now.
Yeah, let me share right here and see.
Yeah, we got the US dollar where people think it might be turning. Interest rates are clearly pressing that 350 on the 10-year. And of course, silver and gold look like they're
dying to turn. Don't know if we can get to all of those, but here's the this is the daily chart of silver. And I've been talking about the fact that I think that that in my experience, silver or inflation always takes time to show up in the metals, and I think eventually it will. And I think that eventual time may be coming. Today was a big move. Today we're up almost a full $1 in silver in this last, and you can see how we broke the recent low. It's still in a downtrend. I drew some tops line here. Yeah. I drew another one here. You can always draw these almost the way you want to fit your thinking, but these are the two basic ones. This can be an area where I'm going to be watching, because we have a lot of accumulation here too. But I think this strong move, again, this is the 8 over the 34. Smarter traders and I may look to look for confirmation there, a couple of closes over these two moving averages, in order to give somewhat of a confirmation that we may at least see the $21 level, and then the $22 and $24 level. But I think this is a market that I do believe that we need to keep our eye on, because silver can be very, very sensitive in times. And look at this, the price. I mean, we're sitting here, we hit 1750 a couple of weeks ago, or early last week, and that was so there's a lot to be excited about here in that market. Even if you look at this is the 60, you can see how we're this is making Dennis smile as we're just hugging that 8-bar exponential moving average. I mean, this was the low over here, it said, but look at how we've moved off that, and then on an hourly basis, and challenged it. Never, I called the 34 a guardrail, that we've never really challenged the guardrail. Let's take a quick look at
Norm, real quick. What's the yellow moving average? Because that seems to be a reasonable one to trade against.
Yeah, that's the 8-bar exponential moving average.
You got a buy signal there, just above $18. So right now that's looking
right in here. Right in here. Here's a lose. Now, this is what I call a guardrail. As I mentioned on Dennis's chart, this would be something I would be looking to go short, but I don't go short because I cannot take my scalp. Let me explain what I mean. When I take a short position, and this also relates to something that Dennis said, that everybody's looking for too much out of a market. Scalpers are always complaining that they should have left something in the market because the market really moved. On the other hand, people who always look for the extended more than what the market is giving them, and seeing it back up and then becoming a losing trade, are always wishing they took the low-hanging fruit. So when I coach traders, I'm always advising them strongly to take on 2 positions when they do. This would not be a position that I would take, because it's against the guard. I don't have enough for the scalp, and when I take a scalp, it's equivalent to the length of the body. So I would be projecting this length of the body, because this whole theory, this whole trigger, is really based on the fact that there's indecision in a doji, or a very small body, followed by a decisive move through the other side of the 8. That to me can trigger new momentum, and that's what I'm trying to do. I'm trying to trigger new momentum, and if it doesn't happen in 6 bars, 1, 2, 3, 4, 5, 6. If I did take this, and I wouldn't because I don't have enough room for my scalp before I get to the 34, I would have been out after 6 bars. So we have certain rules that, if a trigger is not going, the further you get from a trigger, the less impact it's going to have. But here would be the perfect trigger. This is the kind of trigger that would be a maximum position for somebody, because it's going with the trend. It's got a very short risk. I always put the stop underneath the formation, whichever is lower in the 2-bar formation. So this would have been a risk, very small, and look at this gain, just tremendous. So and this, of course, is a 60-minute chart, and I'm not sure how many traders actually trade a 60, but let me it works well. That particular theory of having 2 positions, getting out of it. Once you take your scalp, incidentally. So in this position, I would have taken 2 positions here. I would have taken my scalp out right here, and then I would have moved my stop to break even on the 2nd position. That's the process. And there are other exit strategies. I mentioned one here when things, they don't always take off as soon as you you put it on. But that's kind of the way I'm looking at that market. Let me look at see if I've got the I think I've got the bond market here.
One thing I'm also thinking is, you cut a dollar move on the silver, like just went above there. You could take that dollar profit and turn it into a long-term call spread. And now you got a free look at the silver market for the next year.
Well, now you're talking options, and that's a very
I'm saying they can be used in concert. Some people do that. I always thought it was a good idea, because then you're taking a speculative position with found money.
Yeah, it definitely makes a whole lot of sense.
If you were a believer that we're going to have a much higher move down the road.
Correct.
Yeah.
And I think I think so. And again, I would be, before I pour it in, I would be looking for a little bit more confirmation on a daily basis. But here is a something I wouldn't have taken on the downside of the bonds. Here's something that I would not have taken right away. But here's another formation. It probably would not have been in this move. Would have been in this possibly this move here. You can see with this trigger. Here's here again is a perfect trigger. You've got what I want, a series of non-events, a series of indecision, followed by a move through the 8, even though it's a shallow break here. But we've tested the guardrail. We've moved back into the trend. This money they're in a way giving it to you, at least to the matching of this. In multiple positions, I would have taken out some on the challenge of this bar. But you can see how well. Here's another trigger here that would have led some, and if you weren't in there, you may have been in here. So that's a very reliable. Here's a losing trigger, okay. But when you lose a little. When you win, you've got a chance of being one of the first ones in a trend. And again, it's not flying in the face of what Dennis said about people dreaming. That's the big problem. People think, oh, this is the big one. This is the one. And so if you can take your scalp first, move your stop to break even, and live with the rest according to certain exit rules, I think you got a pretty good plan.
And you tend to come out of a multiple position, not all at one time, correct?
Right. I take the first scalp here, and then when I get a challenge, I'm always looking for a challenge. I'm looking for generally 2 closes over. This actually would be a reversal where you would get out of both here. You would take your profit here and go long if you wanted to with the system, and you would have had your scalp here, and then the second position to break even. So even on counter moves, if you take the scalp, move to break even, a lot of good things to happen. Again, that's just a beautiful signal. So there's a lot of things that, when we get too far, when the market gets too far from the guardrail, or especially too far from the guardrail and the 8-bar exponential moving average, you got to look to peel some off if you've got some left. So,
that makes sense.
So there's a certain rules that I go by. We also have what we call nuances, which I've really never heard people talk about. But if I'm looking, if I was short here and would cover with 2 closes above the 8, okay, we're below the 8. We're staying in. Here's 1 close above the 8. Here's 2 closes above the 8. And if I really wanted to stay in, one of the nuances, people love to stay in moves, they think, but if you're of that ilk, if you're that kind of person, I don't want to take that from you, but I don't want you adding a lot of risk. No. So when this happens, if there's not a lot of risk to add, you could put your stop above the high of the 2 bars that broke. You would have stayed in this position. And you would have stayed in this position too. 1 close above, 2 closes above. And then if you wanted to stay in, you would have put your stop above here. You would have been challenged, but you would have been in the move. So there's a number of things that I call nuances, and that really match a person and their personality. Right. It's easier to match a trading plan to somebody's personality than it is to change somebody's personality. So I try to do as much as I can about in that respect. So just wanted to show you those things.
Perfect. We're at the top of the hour. Dennis, could you just summate how people can get a hold of you, and if you have any special offers, could you extend them now?
Yes. Let me share my screen.
I still want you to introduce me to Tom Hanks, Dennis.
Okay. Get back to my screen. So this is my website, www.CastAwayTrader.com. And here you can see examples of my analysis, and you can click pricing. You can see potential plans you can subscribe to. And you can follow me on Twitter. I post a lot of free stuff on my Twitter account. And I offer 2 video courses. They are uploaded and available on udemy.com. This is the largest educational platform in the world. And my courses are one of the best-selling video courses. I charge only $79.99 for a lifetime, and you get 10 hours of video lessons. And you will be able to get connected to my chat room for free, to educational part of the chat room, and you will be able to send me your wave counts, and I will be happy to answer your questions. If you're only starting with wave theory, I would recommend you to subscribe to that video course for beginners, and I have special price until September 30. And this is how my plans look like. If you trade only ES Mini, you can subscribe for 3 months plan for $149.99. I would strongly recommend you to consider that plan, which includes coverage of ES Mini, NQ Mini, RTY Mini. And what that means is that from 8:30 a.m. in the morning until 9:30 p.m. Eastern time, you will get a handful of updates every 15-30 minutes. And in those updates, I will show my wave counts. I will explain how to convert them in attractive trading setups, and you will get a lot of educational stuff alongside the process. And now I offer specials with coupon offer. You will be able to start your 15-day trial for only $1. So this is how you can find me. Again, you go to CastAwayTrader.com, or you can send me email, which is CastAwayTrader@gmail.com, and I will be able to send you links to those discounts and instructions how you can subscribe to video courses, or how you can start your 15-day trial of my service for only $1.
Okay. Thank you very much for being here, Dennis. That distinction that you make with the harmonic Elliott wave, I think people should really investigate and see more about that. So thank you very much for being here.
Thank you for inviting me.
Yes. Norm, again, how can people get a hold of you? And do you have any special offers you'd like to extend?
I got something for you. I want to share my screen if I could, Dennis. Okay. I wanted to show you this. And Dennis, and did you ever hear of inflation? You're going the wrong way with the pricing. Come on. But that's very
yes, I have the same feeling, frankly.
I mean, come on, you're killing us here. Now, I really appreciate your listen. I think anybody that can step in, the more you hear, it may look complicated, but it's very much worth understanding how Elliott and harmonics work. I want to show you. I told you I wrote a paper. It's free. It's if you go to thedisciplinetrader.com/prop-win. I want to give you some. I wrote a paper. It's about 4 or 5 pages long only, and I want to give you some guidance on why it's not the panacea that you may think it is. When trading prop firms give you 90% of the profit, I mean, how do they make money? Believe me, they make plenty. And you need to know how, and you need to know some of the tips that I can give you from my experience on how to pass what they call the combines, the 2 tests that normally you need to pass in order for you to trade somebody else's money. They will give you 100,000, 250,000 if you pass the test. It's doable, but you gotta be solid in your understanding of what they're looking for them, and some of the rules you need to adjust in your trading plan to fit their tight risk parameters. So please do. It's free. Give it a shot, and I think you'll really enjoy reading this.
Okay, thanks. Both of you guys have definitely brought a lot to the table here, so everybody should check out their stuff and take it from there. Thank you, Norm, and thank you, Dennis. As far as Option Professor is concerned, we do have a PDF report that we hand out called How to Hedge Against Market Declines and Upside Surprises, which many investors have picked up and is very, very helpful. So go to Option Professor, OPTION professor.com and pick up that PDF report. We're a little bit over time here today, but I think it was well worth it. I'd like to spend another hour with you guys if I could. So thanks a lot, both of you guys. And I'm going to send it right back over to David now.
Great. Nice meeting you, Dennis.
Thank you.
All right, thanks, guys. Yeah, great show today. Yeah, a lot of good information. So just a quick reminder, be sure to subscribe to Timing Research on YouTube and your favorite podcast app. Also, you can just go to TimingResearch.com. You see on the screen now, that's how it looks right now. That post will become the archive for today's show as soon as I can get it processed. You can scroll back and see any of the past shows or events there. Dennis gave a great presentation for the Fibonacci and Elliott Wave conference that we did last week. So you can find that as well as all the other presentations there. And so I just want to thank my guests again for today. Norman Hallett of thedisciplinedtrader.com, Dennis of CastAwayTrader.com, and the Option Professor of OptionProfessor.com. Thanks, everyone.
Thanks,
David.